Maybe we should start with those comments on bonds not being the place to be. Now, he was specifically talking about government bonds, but then went on to say, you know, the junk bonds are not really the place to be either because you're not getting paid for the risk. What do you think?
So he was talking about when bond yields for the 10-year were below 1%. And you're right. He said bonds, government bonds are not the place to be. And then he took a swipe at high-yield bonds as well. I think what he is saying has been consistent with the view, which is be careful of bonds at those levels. It would be interesting to see what he would write when the 10 years at 140 plus as it is today.
That's a really good point. This letter is one that Buffett works on through the course of an entire year. I saw some people speculating last week that maybe he'd be commenting on what Charlie Munger had to say last week. But, you know, this is something that is written over time that he works on all year and that's gone to print long before some of these changes that we've seen. What I would say, though, is what he points out that you have seen people move out the risk spectrum. That's been pretty interesting to watch and to see. The idea that you shouldn't be jumping into these junk bonds either, that you're not going to get paid for the risk there.
Yeah, the image I have in my mind, and he picks it up in 4 different ways, in fact. The image I have in my mind is that all this ample liquidity has provided the foundation to build the building. And that building has been risk-taking on the basis of liquidity, not fundamentals. And we've added a floor after floor. He talks about various financial engineering transactions, look at celebrity SPACs, etc. And everybody wants to be in the penthouse. So there's always a question mark. Are the foundations strong enough for the building we've built? But his messages are very clear, which is it's hard to find cheap stocks if you're value investors. He didn't like bonds at that point. And he believes in America, as we all do, and he doesn't want to fade the U.S., which I agree with. So if you put all these 3 things together, it leads him to buy back his own stock. And it speaks to a very important signal to investors is whatever you do at this point, make sure you know really well what you're buying.
You know, one thing he said, though, is that they would not even be spending that money to buy back their own stock if he and Charlie Munger didn't think that their stock was undervalued. They look at it very closely and do a real cost analysis of these things. And, you know, they'll sit on the cash for forever, as they've proven in the past, rather than spend it on things that they think are overvalued. They don't think Berkshire shares are overvalued here, or at least they haven't to what they were buying. It was almost $25 billion that they purchased last year in their own shares.
That's right. And remember, Berkshire Hathaway hasn't been one of the fads. We've had various fads go on, and they haven't fallen to one of them. So in relative terms, they've looked cheap, and he's absolutely right to do what he's done.
You know, Mohamed, we're just looking at the top 5 holdings for Berkshire Hathaway. Verizon is the new entrant. That was kind of a surprise. We just found out about that very recently, that they'd been buying Verizon shares. Chevron also made its way into the top 10. He's pretty consistent in terms of saying we buy things and we hold on to them for a very long time. You still see American Express and Coca-Cola, which have been there for the top, you know, in the top 5 for the last 20 years or so. That's pretty impressive, but you do see him switching out of things. It's worth noting that 3 of the top 5 weren't there 10 years ago.
Yeah, and the big one is the airlines, of course, because he wrote a lot about that last time. And he sold his airlines, and I suspect he looks back now and thinks, maybe I should have waited. I also like the fact, what you said in the beginning about Apple. Here's someone who in the beginning was very suspicious of tech stocks, but he revisited. To use Adam Grant's phrase, he was willing to rethink. And that's important because now, as you point out, he thinks of Apple as part of the crown jewels.
Yeah, that's a good point. Mohamed, we talked a little bit earlier about share buybacks because that was a big section in the report as well. We've seen politicians like Elizabeth Warren, some other senators who have kind of come out and said that they're not in favor of share buybacks. Elizabeth Warren on CNBC about a month ago actually called it market manipulation when a company buys back its shares. He's a big proponent of it, and he uses Apple as an example of that, why their stake in Apple has gotten so much more valuable even as they sold some of it because Apple was buying in shares. And then he says, you know, Berkshire shareholders also have a bigger piece of the company's future profits because we've been buying back Berkshire shares. So this is a situation, he thinks, where the Berkshire investors have doubly benefited from that. What do you think about stock buybacks and then the political sentiment in Washington on it, too?
So I think stock buybacks are part of a well-functioning marketplace. And CEOs and boards have to decide where to put their liquidity in the interest of shareholders. The problem, though, and there is a problem, Becky, the problem is we've had highly distorted interest rates. And when you have highly distorted interest rates, it leads to all sorts of other behaviors that are less consistent with a well-functioning market system. So the problem is not buybacks. The problem is the great distortion in the fixed income side, in the interest rate side, because of the over-reliance on central banks. So the politicians are right in a sense of saying, look, there's something happening on buybacks that shouldn't be going on, and that's too much financial engineering. But the problem isn't the buybacks themselves. The problem is what leads to that distortion.
Shepard Smith here. Thanks for watching CNBC on YouTube.